Welcome back to the deep dive. Today, we're jumping straight into what looks like a really compelling turnaround story. We're talking Chennai Petroleum Corporation Ltd. CPCL.
That's right. We're looking at their latest results, Q2 and the first half, ending September 30, 2025.
And our mission here, well, it's more than just reading an earnings report. The sources we've got paint a picture of a massive shift, from really significant losses to, well, pretty impressive profits.
Right.
So we need to unpack how that happened. What were the mechanics behind it, the operational stuff, market factors?
Exactly. And we've got good sources for that. There's the company's own press release. They're calling it stellar physical performance. So you know the angle there.
Okay.
But crucially, we also have the official regulatory filings,
Right.
the audited results, governance details. Gives us much more holistic view, let's say. Compare the spin with the substance.
Absolutely. And usually with turnarounds this big, the story really starts with operations, doesn't it? The physical side of things.
Always.
So let's unpack that physical performance first, because some of these numbers are pretty eye-popping. They definitely set the stage for the financial shift. Okay, so the big one for a refinery, crude throughput. How much oil are they actually processing?
Yeah.
For Q2, they hit 3.013 million metric tons, MMT. Now compare that to the same time last year. It was only 2.098 MMT.
That's a huge jump, almost 1 million tons more in just one quarter. We're talking, what, over 40% increase year on year?
Yeah, massive. How does a refinery even achieve that kind of volume increase?
Well, it points directly to this next figure, which is maybe even more impressive. Capacity utilization.
Okay.
The documents say they achieved 114% capacity utilization. And not just for the quarter, but for the whole half year.
Wait, 114%. How does that work?
Yeah.
You can run over 100% capacity.
Yeah. It sounds a bit strange, doesn't it? It basically means they're running the plant significantly above its official nameplate or design capacity.
So they're pushing it really hard.
Extremely hard.
Yeah.
And consistently. The press release calls it superior plant reliability, which translates to, well, basically nothing broke down unexpectedly.
Right, minimal downtime.
Exactly. They must have had incredibly smooth operations. Maybe they finished planned maintenance, their shutdowns ahead of schedule or very efficiently, and just kept things running flat out.
Is it also about the kind of crude they're using? Does that affect how much they can push through?
Oh, definitely. To sustain 114%, you'd guess they're optimizing their crude slate, maybe using lighter crudes or blends that their specific refinery units handle particularly well. It lets them run faster, hotter.
So it's not just keeping the machines on, it's running them smarter, too.
Precisely. This isn't just luck. It implies really strong operational planning and execution. Discipline, really.
Okay, so huge volume, running way over capacity.
Yeah.
What about the quality of what they produce? Did they just make more low-value stuff?
That's the other key piece. The documents highlight their best ever distillate yield of around 80%.
Distillate yield. Remind us what that means.
So distillates are the higher value products from crude oil. Think petrol, diesel, jet fuel, the stuff that sells for more money.
Okay.
A higher distillate yield means they're converting more of each barrel of crude into these valuable products and less into, say, heavy fuel oil or bitumen, which are lower value.
So 80% is good.
80% is excellent. It shows they're not just pushing volume, they're maximizing the value they get out of that volume. It points to really efficient processing and a focus on energy efficiency within the plant itself.
Right. So the operational side is clearly firing on all cylinders. More volume, higher value products.
Exactly. This physical performance, this is the how. It really paves the way for the financial numbers we need to look at next. It explains how they could possibly achieve that turnaround.
Okay, let's get to those financials then. The shift, especially in Q2, it's pretty dramatic.
It really is. Let's start with the top line. Revenue from operations for the quarter. 20,034 crore.
And last year?
Last year, same quarter, it was 14,424 crore. So a very healthy increase in revenue. But honestly, the profit number's in the real story here.
Yeah, that's the turnaround part. So Q2 bottom line.
Profit after tax, PAT, for Q2 was 732 crore, positive 730 crore.
Okay. And the comparison, last year?
Last year, same quarter, they posted a loss after tax of 629 crore.
Wow. Okay, let that sink in. From a loss of over 600 crore to a profit of over 700 crore.
Yeah, the swing is huge. It's a turnaround of about, 1,360 crore year over year on the bottom line.
Just for the quarter. That's not just a good quarter. That's a fundamental change in the business's profitability, isn't it?
It certainly looks that way. It suggests something shifted significantly, either internally with their efficiency or externally with market conditions, or probably both.
And does the half-year picture confirm this trend? Was Q2 just a fluke?
No, the half year confirms it. H1 revenue was 38,717 crore, up from around 34,800 crore last year.
And the profit for the half?
H1 profit after tax landed at 675 crore. Again, compare that to last year's first half, which was a loss after tax of 287 crore.
So consistent profitability across the first 6 months, reversing last year's loss.
Correct. And even if you look at the consolidated figures, which include their joint ventures and associates, it tells the same story. Consolidated H1 PAT was 679 crore versus a consolidated loss of 277 crore last year.
So the recovery is broad-based, not just in the core refining operation.
Seems so. The sources are pretty clear on the drivers. They explicitly mention improved refining margins.
Which we'll get to.
Right. Plus the efficient operations we just talked about and what they call prudent cost management. So efficiency gains and keeping costs in check.
Okay, let's tackle those refining margins now, because in this industry, that's often the make or break number, right? The gross refining margin, GRM.
Absolutely. The GRM is critical. It's basically the difference between what they sell their basket of refined products for and what they paid for the raw crude oil. It's their margin per barrel.
And this is where the story gets really interesting, as the source puts it.
Interesting might be an understatement. The GRM movement here is pretty colossal. For Q2, CPCL's GRM shot up to US $9.04 per barrel.
$9.04 per barrel.
Mm-hmm.
How does that compare?
Well, remember last year's Q2 when they were making that big loss?
Yeah.
Their GRM then was negative US day $1 for 63 cents per barrel.
Negative. They were losing money on every barrel they processed.
Essentially, yes. The cost of crude was higher than the value of the products they made from it at that point in time. So going from minus $1.63 to plus $9.04. That's an enormous swing.
Yeah.
More than $10 per barrel difference.
That completely explains the profit turnaround then, almost single-handedly.
It's the biggest single factor, absolutely. That margin improvement flows directly to the bottom line.
Is a $9 GRM normal, or is that exceptionally high?
It's very strong indeed. And the source gives us a useful benchmark here. The Singapore GRM, which is kind of a regional indicator.
Right.
That stood at US $2 per barrel in the same quarter.
Wait. So CPCL's GRM was more than double the regional benchmark, $9 versus $4.
Exactly. Which tells you something important. It's not just that the overall market for refining improved. CPCL significantly outperformed the market.
How? How do they manage that?
It comes back to that operational efficiency we discussed, that high distillate yield, around 80%.
Ah, making more valuable product.
Precisely. If you're producing a higher percentage of petrol and diesel, which generally command better prices, and less low-value fuel oil, your overall margin per barrel will be higher than someone with a less efficient setup or less optimal product mix.
So they captured the general market uplift and added their own operational premium on top.
That's exactly what it looks like. Maybe also some savvy crude purchasing, but the product yield is a big factor here.
And the half-year GRM, does it hold up?
Still strong, though slightly lower than Q2 alone. The H1 GRM was US $6.17 per barrel.
Compared to last year's H1.
Last year's H1 was also negative US was $2.93 per barrel. So again, a huge positive swing across the 6 months.
Okay, so that GRM shift clearly explains the profit before tax numbers too, right? Q2 PBT was 994 crore.
Compared to a loss before tax last year of 857 crore, yeah, the GRM is the direct driver there. A strong positive GRM just floods the income statement with potential profit.
All right, so the operational story and the financial results, especially that GRM, they paint a really impressive picture. But now we need to pivot, right? Look at the fine print, the regulatory stuff.
Yes. Away from the press release highlights and into the formal audit report and filings, this is where you often find important nuances.
First off, the auditors, RG& Price & Co., they gave an unmodified opinion on both the standalone and consolidated financials.
Which is good. It's a clean bill of health on the core accounting. It means the main financial statements, balance sheet, income statement, cash flow are presented fairly according to the standards. No major issues found there.
But there's always a but in the footnotes, isn't there?
Yeah, often, yes. And here, it's important what the auditors specifically excluded from their opinion. They made a point of saying their audit didn't cover certain voluntary disclosures made by management.
Like what?
Specifically, things like the quantitative info on crude throughput, that 3.013 MMT number, and crucially, the average gross refining margin. that $9.04 figure.
So the auditors didn't actually verify the GRM number.
Correct. They're not saying it's wrong. They're just clarifying that their audit opinion covers the statutory financial statements prepared under accounting rules, not necessarily the operational metrics or management calculations like GRM presented alongside them, often in the notes or press release.
That's a really important distinction for anyone analyzing the company. The headline GRM is management's calculation, not an audited figure in the same way profit is.
Exactly. It's a key performance indicator. Very useful, but understand its basis. The auditors also excluded various ratios from their scope.
Okay, now let's look at the structure. The filings talk about related party transactions, RPTs. Who's the main related party here?
No surprise, it's the holding company, Indian Oil Corporation Ltd, IOCL.
Right, state-owned giant. And the scale of transactions between CPCL and IOCL.
It's massive.
Yeah.
Essentially, CPCL functions almost like a captive refinery for IOCL. The numbers show sales of product and services to IOCL for just the first half of the year totaled 36,834 crore.
Wow, almost 37,000 crore. So basically, almost everything CPCL produces gets sold straight to its parent company, IOCL.
That's the picture, yes. It shows how tightly integrated they are. CPCL refines it, IOCL markets and distributes it.
Are there other significant purchases?
Yes, there's a notable purchase of RLNG from IOCL, amounting to 1,317 crore in the half year.
RLNG, that's regasified liquefied natural gas.
Correct. Refineries need a lot of energy for heat, for processes, power generation, so CPCL is buying a significant amount of its fuel gas from its parent, IOCL. Further proof of that deep operational linkage.
The filings also mention JVs and an associate company.
Yeah, Indian Additives Limited and National Aromatics and Petrochemicals Corporation Limited as JVs, and Cauvery Basin Refinery and Petrochemicals Limited as an associate. Standard corporate structure stuff for a company this size.
Okay, finally, governance. Did the auditors flag anything there? Sometimes the other matters section of the report has nuggets.
It did indeed. And this one is quite significant. The auditors pointed out a non-compliance issue.
Oh.
The company doesn't have the minimum number of independent directors on its board, as required by law, specifically the Companies Act and the SEBI regulations.
They're short on independent directors.
Yes, and the report specifically mentions the lack of the required woman independent director as well. This isn't just a suggestion. It's a legal requirement for listed companies of this size.
That seems like a pretty basic governance requirement to be missing. Does the report say why?
It does. It notes that the appointment of these required directors is, and I quote, in consideration of the government of India.
So because IOCL is the state-owned parent, the director appointments are ultimately influenced or decided at the government level, and that process hasn't filled the vacancies yet.
That's the clear implication. It highlights that even while the company is performing exceptionally well operationally and financially, there's a fundamental governance piece missing. And the resolution lies with its main stakeholder, the government via IOCL.
Right. Okay, let's try and wrap this up. What are the key takeaways for you, the listener, from this deep dive into CPCL?
Well, first, you saw incredible operational leverage. That 114% utilization and the record 80% distillate yield, that's the engine.
Yeah, that efficiency was really the foundation.
Then you saw how that efficiency, combined with a very favorable turn in market conditions, specifically that huge jump in GRM to over $9.
Compared to negative last year.
Right. How that combination completely flipped the financial results. From deep losses to very strong profits, it's a classic case study in how refining fortunes can turn.
But then there's the caution from the fine print.
Exactly. The auditor's report reminds you to distinguish between management's performance metrics, like that stellar GRM, and the core audited financials. They're related, but not the same thing from an assurance perspective.
And the governance flag.
And the governance flag. It shows that even a company firing on all cylinders operationally can have significant compliance issues waiting to be resolved, often due to factors outside its immediate control, like shareholder or government action.
So the big picture is undeniably impressive. Operational strength turning into financial success. That U.S. Scion dollar GRM is the headline number reflecting that this period.
Definitely. It shows the power of getting operations right when the market wind is at your back.
Yeah.
But as we saw, you always need to read the footnotes. They tell an important part of the story, too.
Which leads us to that final thought for you to chew on. We see stellar results, superior plant reliability, a massive financial turnaround. Yet, the auditors highlight this ongoing governance gap, the lack of required independent directors, including a woman independent director. So the question is, how sustainable is top-tier operational and financial performance if foundational governance requirements mandated by law remain unaddressed because the key stakeholder hasn't acted? Can operational excellence mask governance risk indefinitely? Something to think about.
A very relevant question.
That's all for this deep dive. Thanks for joining us.